Hi, welcome to Finance. This is Chapter 8, Risk and Return, and I'm going to be talking about a few key principles. So let's look over the key learning goals. So in this chapter, I want to introduce risk, its relationship to return, and talk about some risk preferences. I want to talk about how to measure the risk of a single asset and discuss the measurement of portfolios using statistical measures like standard deviation and correlation. We're also going to look at how these characteristics are going to affect a portfolio in relationship to diversification and international assets. We're going to talk about beta and the role in measuring risk in a portfolio, and we're going to look at and talk about the capital asset pricing model, as well as the security market line. Okay, so what is a portfolio? Pretty simple question. It's a group of assets that's been put together, hopefully for a return that also lowers risk. So risk is going to be, of course, a measurement of the possibility of not getting compensated for your investments. So the risk is that your investment will not provide you the return equal or greater than the uncertainty of the investment itself. So what is this concept of return? So when we think of an asset, buying an asset, later selling an asset, seeing what type of gain we've earned, we're going to call that a return. So it's going to be the total gain or possibly loss when over a specific investment period, say a year, 5 years, or 10 years. And so we're going to accumulate this gain, and we're going to divide it by the asset's cash distributions plus any change in value of the asset from its beginning to end period. Here's the basic formula. So total rate of return, C here is going to be the cash flow received. P to the T will be the price of the stock at the current time, at the time of the sale. P to the -1 would be the purchase price of the stock. So -1 is time minus 1, so that's really the beginning price, and this is the ending price. Then this would give us our total return divided by the beginning price would give us our return percentage. Now, so here's an example. Robin, a good friend of mine, wishes to determine the return on two stocks that she owned from 2016, Apple and Walmart. So at the beginning of the year, Apple traded about $105 per share, and Walmart stood at about $61 per share. Apple paid a dividend of $2.37, Walmart paid a dividend of $2. So at the end of the year, Apple stock was up to $115 and Walmart was up to $69. Using the equation that we saw in the previous slide, we can calculate the annual rate of return. So here we put in the cash flow, ending price minus beginning price divided by beginning price. Mind the parentheses, so all this has to be calculated first, divided by the beginning price, and we get a 12% return for Apple, where Walmart gets a 15.7% return. So she made money on both stocks over that period. So let's talk about return. Realized return and expected return. So the realized return, of course, is the return that you end up with. The expected return is what you expected the asset to generate in the future. So it's going to be composed of, again, calling back to chapter 6, the risk-free rate plus the risk premium. So we have a realized return, and then we have the expected return. And the expected return helps us to gauge or manage the risk of an asset. So if we look at treasury bills, treasury bonds, and common stock, so remember, treasury bills are shorter term treasuries, and treasury bonds are longer term treasuries. So we see that the nominal rate of return is 3.8, 5.3%, and 11.4%. And then we have the average real return, which is going to factor in what the return would be after inflation. Okay, so let's talk about some risk preferences. So seeking risk or risk seeking, this would be an attitude of investors where they prefer greater risk even if it results in lower expected returns. So you can see that risk preference probably is not ideal. Risk neutral would, the attitude towards risk in this pool of people, which we'll call investors, they want to choose the investment with the highest expected return regardless of the risk. And this is often a lot of new stock investors may be attracted to companies that could provide a high expected return and never really stop to really think about what the risk is associated with that return. So sometimes inexperienced investors may be risk neutral. They're not really concerned about the risk. They're all about the reward. Risk adverse would be a more seasoned or experienced investor whose attitude towards risk really is that you're going to need more return to compensate for increasing risk. So this is someone who looks at their investments in a smart kind of way to kind of determine, if I'm going to take a risk in this particular stock or bond, I'm going to determine the return I need to compensate me for that risk. So that would be a smarter investor. All right, so let's talk about risk assessment. So there could be a scenario analysis where we look at several possibilities. So in this analysis, we may look at a best case scenario, a worst case scenario, and a most likely case scenario. So we just kind of plot out different things that could happen and see how that affects our return. A measure of an asset's risk using a range, we find by subtracting the risk associated with the worst outcome from the risk associated with the most optimistic or best outcome. And this will give us our range of returns based on our scenario. Now, probability distributions, this is a little bit closer tied to, say, standard deviation. So we want to look at what is the probability a certain outcome is going to occur. So we can make a distribution, which is like a model where we can relate these probabilities to different outcomes. And we can express this with a bar chart to show the distribution of these properties and give a better visual display of the probabilities of a given event. And we have to keep in mind that this is a continuous probability distribution, so it's going to be showing all possible outcomes associated with a given event. So here are two assets, asset A and asset B. So which is riskier? And I think if you look at asset A, the low end of which is a 25% probability, is a 13% return. A 50% probability is a 15% return, and another 25% probability is a 7% return. And those equal 100%. Over here, asset B, we have a 25% chance of, say, a 6% return, and then we have a 50% chance of a 15% return, and a 25% chance of a 23% return. So which is riskier? Well, B is riskier because the dispersion is greater than A. So the worst you can do in A is make 13%. The worst you can do with B is only make 6%. Although the gain on B is larger. So these are two stocks. If you're looking at just risk, A would be less risky, but B would have more potential for return. So let's look at this example. Norman Company's past estimates. So they're going to look at the probabilities of pessimistic, most likely, and optimistic. So we're going to put those at 25, 50, 25 respectively. So 25% refers to pessimistic, 50% most likely, 25% most optimistic. So this has to equal 100% to be a continuum, and this is the probability distribution that we're going to be working with. So that's going to encompass all possible outcomes because it's within this 100%. Let's talk about the black swan. So what is a black swan? It's a concept that for a long time, nobody thought there were any black swans. It didn't mean it didn't exist, but no one really had it well documented until one actually showed up, and then it was, something no one expected. So that's the basic concept. So we had a black swan event in 2007, 2008 with the mortgage market crisis and the Great Recession. So most of the time people believe like most of the events in the stock market are going to be white swans, something that's very common, everyday occurrences. Companies make money, stock prices go up. But every so often, a black swan will be discovered or come about that nobody expected, like the financial crisis in 2008, the huge internet stock bubble of the year 2000, the coronavirus of the year 2020. These are all black swan events that take the stock market and the bond market off guard because no one expected that was going to happen. No one planned for it. It was a completely unexpected event, and that can dramatically increase risks for the market. So one should always keep in mind that the best assembled portfolios can still fall victim to a black swan that has the ability to lower values in many different asset classes across the board. So look at these bar charts for Coca-Cola and Google. So if we look at the Coca-Cola's monthly return, so we're looking at the frequency of outcome from 0% to 50%. And we see that most likely the Coca-Cola's monthly return is going to be 0 to 5%. And that's the same for Google's monthly return as being 0 to 5% being the most common, but it doesn't have it has a lower frequency of occurrence. So the returns for Google have a more flattened curve where there's a chance of losing more money on one end and making more money on the other tail of the other end, where Coca-Cola is more tied up in a more tighter distribution. So based on these two charts, we'd say that Coca-Cola is less risky than Google. But you have to also think about Google might be more risky, but it's also going to pay off higher returns if things go well. And if you look over the last, say, 10 years of Google and Coca-Cola, you certainly would have done much better off owning shares of Google than Coca-Cola, even though Coca-Cola is less risky. So then that is basically what an investor would think about. So if you're an investor who has a lower risk tolerance, you might prefer companies like Coca-Cola, but maybe you're a younger investor who can absorb higher risk, then you might be more of a Google investor based on your risk preference and outlook. So how do we measure this risk? Well, we could use standard deviation as a measure of risk. And standard deviation is a good measure of risk because we're looking at the dispersion of the returns around the average return for the asset. So in this formula, and I'm sure everyone here has worked with standard deviation before, either in high school or one of the earlier math classes you've taken or a statistics course, all should have delved in or introduced the idea of standard deviation to you. And basically we take the average return and we're going to look at the return for the J number of outcomes. So R to the J would be the number of outcomes, probability of occurrence, and the number of outcomes considered, which would be N. So it's a summation of these outcomes compared to the average return. So we could make a risk measurement of this. We can take this formula and we can calculate. First, we would need the average return to be estimated. So it's just a simple average formula where we take the sum of the returns and divide by the number of, say, years we're looking at. So for example, let's look at Norman Company again, stocks A and B. So column 1 will give you the projected, and column 2 would give you the return and the projected occurrence. So J to the TH is the projected occurrence, and R to the J is the return. So here we have asset B and A. So here's the probability of occurrence. So we talked about this previously. Pessimistic, optimistic, most likely, the three scenarios. Here are the returns in each of those cases for these two assets. And then if we multiply the probability by the return, we're going to get a sort of a weighted return that if we add up, we'll calculate the average return. And both these portfolios have the same average return. So we want to look at what is the risk associated. So if we take the standard deviation formula, and we put this information into the standard deviation formula, so this information can go into the standard deviation formula, and asset A and B, and the data standard deviation for asset A is 1.41, and standard deviation for asset B is 5.66. So the higher the standard deviation, the more riskier the asset is. So we consider asset B to be have a higher standard deviation, have a higher amount of volatility and risk. Remember, you can only compare the standard deviations if the average returns are equal. You can also look to the textbook or my additional video where I do some Excel work to show you how to calculate standard deviation, because it's not something can easily be shown through a PowerPoint slide, the actual calculation. So this is, why, they'll break down what we're doing here when we're trying to make the calculation, but this is best viewed in the Excel spreadsheet video I'm going to post for this chapter, which will go through standard deviation. But this is sort of the longhand of it to calculate the two standard deviations. Okay, so as you know, not all stocks are created equal, right? Because stocks are based on companies, and companies have, different risks, different businesses, financial and business risk, environmental risk, political risk, company culture risk. So how do we really show between stocks, which is riskier, but also we can also compare stocks as one asset class to, say, bonds. So we know that historically stocks are riskier than bonds, but we can use some of these statistical tools to show the standard deviation of those two different asset classes. And we can also look at large stocks and small stocks, and by and large we found out that the returns for a long period of time, almost 100 years, we can see that small stocks return 16.6% on average, while larger stocks return 12%. So the standard deviation, though, of returns was a higher 31% for small stocks compared to large stocks at 19.9%. So what this basically says is that, large stocks are less riskier but have a lower return compared to small stocks. So I guess if you're an older investor, you might prefer larger stocks for the reduced risk. But if you're a younger investor, small capitalization companies might be a better longer term payout. Okay, so let's introduce the idea of the coefficient of variation. So we have our nominal returns for treasury bills, bonds, and stocks. We have our standard deviation, which is looking at, basically the dispersion of the return. Now, so you would say, okay, common stocks are clearly a much riskier than bonds. But if you actually look at the coefficient of variation, because they have different average returns, stocks are not that much riskier than bonds, because bonds have a much lower average return. So even though they have a lower standard deviation, and the way we find this number is we take the standard deviation and we divide by the average rate, average nominal return. And this gives us a coefficient of variation. So these are what is comparable, not standard deviation, because these three asset classes have different average returns. So we can see that, yes, stocks are more risky, but not as much more riskier than bonds if you look at the coefficient of variation in relationship to the standard deviation. So let's talk about normal property distribution. So this is a symmetrical property distribution that's going to resemble a bell curve. So a bell-shaped curve is something that is often used to talk about grades as well, like the bell curve. So let's just go back here for a second. This is table 8.5. So we're going to reference table 8.5 when we talk about this slide here. So in table 8.5, we're assuming that the probability of distribution of returns for common stocks and bonds are normal, and we're going to surmise that 68% of the possible outcomes would have a return ranging between negative 8.4% and 31.2%. So what we're talking about degrees of standard deviation. So this is 68% is going to be one standard deviation. Now for stocks so that would be, if we're looking at stocks, 3.7 and 4, stocks are 8.4 to 31. Bonds are going to be 3.7 to 14. So 95% of the possible return outcomes would range between negative 28 and 51%. So that would be two standard deviations for stocks, and negative 12 and 23% for bonds. So the greater the volatility, because stocks have a greater volatility, we can really see this reflected in the possibilities of return. So when we say possibility of return, we say that 95% chance stocks are going to return somewhere between negative 28 and 51%, or there's a 68% chance they'll return either a negative 8 to 31%. So we're using standard deviation to put on a probability of occurrence. So one standard deviation would be the actual calculation. We could add that or subtract that from the average return. So you can go to 2 or 3 standard deviations, and the more standard deviations you built in, the higher the return. So we could look here. This would be plus or minus 1 standard deviation. So if the average return was 10% and the deviation was 5%, this would say there's a 68% chance you'll have a 5% or a 10% or a 15% return. On average, you're going to have a 10% return, but the 68% chance that return will be between 5 and 15%. If we do 2 standard deviations, then there's a 95% chance your return will be 0 or 20%. If we do 3 standard deviations, there's a 99.7% chance your return will be negative 5, because I'm subtracting from the base of 10, I'm subtracting 5, 1, 2, 3, so 5, 10, 15. Negative 15 from 10 is negative 5. And then 5, 10, 15, 15 plus 10 is 25. So we have a range from 25 to negative 5 is a 99.7% occurrence. So this is how we could use the bell curve and the probability density to look at the percentage chance a certain return range will occur. So coefficient of variation I mentioned before, and I told you take the standard deviation divided by the average return. This gives us a measure of risk that can be comparable between asset classes. Sort of the taking apples and oranges and making them all comparable. Because you can't compare different assets which have different average returns. But with coefficient of variation, you can compare assets with different expected returns. So in this example, we could look at those portfolios A and B, and we could see that if you take the standard deviation divided by the average return, which is going to be 0.94. And for the second class, you take the standard deviation divided by the average return, you have a 0.37. So the asset with the higher coefficient of variation would be considered more risky, or a higher dispersion. Okay, so let's look at portfolio returns and standard deviation. So in an efficient portfolio, we want to maximize return and minimize risk. So whatever the given level of risk is, we want to maximize our return to compensate us for that risk. So what we could do is calculate a weighted average return on a portfolio, which is the formula here. And this, again, look for the video on the spreadsheet for Chapter 8, Risk and Return, where I'll show you how to calculate a portfolio return and a standard deviation. So I'm going to skip this example because it's basically doing a weighted portfolio between Cisco and Walmart. So those examples I'll show you in a spreadsheet. Okay, so in these couple of slides I'm going through here, we're looking at, these are going to set up the next big table, 8.6. So basically, think about a portfolio consisting of X and Y. So what would be the best return of X and Y as far as percentages? So what we can do with this is, if we have two portfolios, X and Y, and this would be the given year, and they're breaking these portfolios out evenly by 50%, we see that for any given year, the return of these portfolios is going to be 12%. So together, the portfolio together with both assets are going to give a very consistent return of 12%, which is a standard deviation of 0 because there's no deviation here. But each asset by itself has a standard deviation because of the fact that we have a different range of returns. It just happens that you see how these are, if you look across, these are pretty much mirror portfolios. So they perfectly balance each other and make a perfectly predictable return. That's really a rarity in most cases. But this is how you could use two assets assets that are in really inverse return can be combined to make a more stabilized portfolio. Let's talk about correlation. So correlation is a statistical measure of the relationship, of course, between two assets or a series of numbers. Now, so we have positively correlated, which, think of two people who are handcuffed. So they would be positively correlated. So wherever one person is, the other person is. Negatively correlated would be two people on the opposite ends of the Earth. Maybe one person lives in the North Pole, one person lives in the South Pole. We would never see them together. So those are the two extremes. We could create what's called a correlation coefficient that will measure the degree of correlation between the negative and positive. So you could have somebody who, maybe two people are friends, where sometimes they're together, sometimes they're not together, so they're neither perfectly positively or negatively correlated. So when we look at stocks, we want to track the movement of the stock price. Now, perfectly positive correlation would be a perfect one, where that would be the handcuff scenario, where two people are always in the same place together. Or it could be two assets that always have the same return. Perfectly negative correlation would be two assets that have perfectly opposite returns. So one asset makes 10%, the other asset is negative 10%. And that's shown by -1. Now a 0 would show an unrelated or uncorrelated amount of return between the two assets. So there would be really no predictability in where the return of either asset would be in relationship to each other. So here would be graphically how you could look at two assets, M and N. So perfectly positively correlated, they're moving in unison, and negatively correlated, they're moving in opposition. So diversification is the idea of, let's build a portfolio by combining a number of assets that we're going to have a low correlation to each other, so we can eliminate some risk. So if they have a low correlation, then the variability is the volatility and the variability of the returns of the portfolio will be reduced. So, but we want a combination of assets and correlation. We don't want it to really be perfectly negatively correlated, which would be a portfolio that returns nothing all the time. So we want some kind of a correlation that's going to be in alignment with what our risk preferences are. So for example, you look at asset F and asset G, if we put these together in a portfolio, we have a much smoothed out returns and losses when both assets are together, because they have their correlations are more of a negative correlation than a positive correlation. So if we combined assets X, Y, and Z into two different portfolios, one that would be X and Y. So X and Y you see how they have different returns each year, but they both have the same average return and the same standard deviation. But combining them into one portfolio, we're able to reduce the standard deviation down to zero, which means a much more consistent return of 12% with very little risk. If we combine assets X and Z, these are perfectly correlated. So the returns are identical. So combining two perfectly correlated assets together doesn't reduce standard deviation or risk. Okay. So the risk of the portfolio, when we think about our portfolio, we want to think about correlation, diversification, risk, and return. So we're looking to have assets that have a lower correlation. We don't want perfectly positive or perfectly negative assets. We want assets that have different correlation aspects to reduce risk overall, which is going to be achieved by diversifying and acquiring a number of assets. So the concept is that in some years, some of the assets will do well, but not all of the assets. But most years, more of the assets will do well than not do well. So that would protect us from having all our money, saying put all your eggs in one basket and have all your money in one stock. So here we have ranges of return. So if we look at perfectly positive, perfectly negative, and uncorrelated, between 6 and 8%. So this would be portfolio, the average return of the portfolios. If we look at portfolio risk, the standard deviation, the risk ranges between perfectly positive, the risk is the smallest, compared to uncorrelated and negative as far as the range of possible correlations. Now let's talk about international diversification. So here what we're going to talk about is you don't want to, for most portfolios, you don't want to put all your stocks just in one country. So to have a more well-diversified portfolio, you want to have international diversification and include stocks from multiple countries to help reduce the risk that if one country has a economic disaster or a natural disaster or just is not doing well with inflation, it doesn't totally ruin your portfolio. So we can avoid this country risk by having a portfolio built up of many different countries. So in some cases, international diversification will have a more stable and predictable return than domestic portfolios, but not always. Now we can also talk about political risk. So in international diversification, not all host governments are the same. Some are dictatorships, some are democracies, some are socialistic. This means that their policies they enact could be harmful to some foreign investors or to the companies themselves. So you have this political risk that the politics of the country can also affect the return. So let's talk more about risk. And one way we can measure risk is using this capital asset pricing model, which is a great way to measure risk. So when we talk about types of risk, there are two types of risk: non-diversifiable risk and diversifiable risk. So together, that's going to be the total security risk. So let's talk about diversifiable risk first. So these are the assets that, random events could happen to these individual assets or companies that can be eliminated through diversification, sometimes also known as unsystematic risk. So what we're talking about here is, you could have 10 different companies and geographically located in 10 different areas of the world would help eliminate some risk of a natural disaster occurring in any one location. So we could diversify from many of these risks by just having multiple companies in different industries in different locations. Okay. Now, the non-diversifiable risk we'll talk about. Now, these are risks that you're not going to be able to eliminate through diversification, sometimes called systematic risks. So these non-diversifiable risks could be, say, inflation. So inflation is going to affect all companies, or it could be the market risk, the risk the market is going into a bear market, and this is going to have some effect on all companies. So non-diversifiable risks can't be improved by adding additional number of assets. So it's only diversifiable risk that will improve. And this graphic shows it pretty well. So if we have only one asset, in this one asset, we're going to have all the non-diversifiable risk plus all the diversifiable risk together. As we add securities and we go to, say, 10 stocks, now we've shrunk the diversifiable risk from this position down to here. And you notice that the non-diversifiable risk doesn't change. It doesn't matter how many companies you add, this non-diversifiable risk will never lower. It's only the diversifiable risk that will lower. And typically the school of thought is between 25 and 30 assets will reduce diversifiable risk as much as you can get it down. So there's always going to be some diversifiable risk, but having at least 25 to 30 assets in the portfolio greatly reduces this diversifiable risk, because now you're placing bets on many different horses. Okay, let's go back to the capital asset pricing model, or CAPM. This is a model that's going to work with the non-diversifiable risk, and we're going to link that to the expected return. We're going to utilize what's called beta coefficient, which is going to be our measure of the non-diversifiable risk. So beta coefficient is sort of closely related to those coefficient factors we talked about earlier, and we'll talk more about this in a few minutes. But this is it's going to be an index where we're going to measure the movement of one asset to the market, and that's what beta coefficient does. And then, of course, the market return is going to be the return of the portfolio for all the securities traded. So let's go back to the beta coefficient. So what we're going to do with the beta coefficient is basically it's going to be a slope of a line is going to show us our beta. So here, for example, in Bank of America, if we take the slope of this line, the beta is 1.73. And the slope of PepsiCo, the beta is 0.66. So this basically looks at the reaction of the market return when we're moving from a return from 0 to 20 or 0 to negative 20. We look at the reaction. So the steeper the slope, the bigger the reaction. So Bank of America has a much more reactive stock at a higher beta, and PepsiCo has a more flattened stock with a lower beta of 0.66. So the higher betas react more to market return or changes in the market than lower betas. So that's what's going to be our measure of risk. So let's look at this scale here. So we have stocks that are all moving in the same direction as the market. So if your beta is positive, your stock is going to move in the same direction as the market, which means the market goes up, your stock goes up. So beta of 1, the market goes up 10%, your stock goes up 10%. A beta of 2, the market goes up 10%, your stock will go up 20%, statistically. 0, your stock would be unaffected by market movements. But if your stock had a negative 1 beta, if the stock market went up 10%, your stock goes down 10%. With a negative 2 beta, if the stock market went up 10%, your stock goes down 20%. A beta of negative 0.5, the stock market goes up 10%, your stock goes down 5%. And if your stock had a beta of 0.5, if the stock market went up 10%, that's right, you got it, your stock would only go up 5%. So you can see how this is a measure of movement, of correlation between the stock price and the market. So that's a really nice measure of risk that we can use. And luckily for this class, you don't have to actually ever calculate the beta coefficient. It's going to always be presented to you. So you can utilize it in the capital asset pricing model to calculate return. So if we're going to interpret a beta, we're going to look at the beta coefficient for the entire market, which is always going to be equal to 1. So that way we could take the betas of other assets in relationship to the market. And stocks can have positive or negative betas are pretty common, but majority of beta coefficients for stocks in the market are going to be either between 0.5 and 2. That's going to be at least 80% of the betas of stocks. Here are some examples from 2017 of some beta coefficients for different stocks. These are all, of course, are quite different today. So the capital asset pricing model, we're going to use the beta coefficient in that model. But we could also create a beta for a portfolio, which would be a weighted average beta for a portfolio of assets. And this, again, I'll detail in my spreadsheet video of these calculations. So if we look at these two assets, two portfolios, portfolio V and portfolio W, we can see this is the percentage portion. So asset 1 is 10% of the portfolio and has beta 1.65. But asset 1 is also 10% of W portfolio with a beta of 0.8. So if we're looking to compare these two betas, these two portfolios, we can create a weighted average beta for both of these portfolios, which I'll show you in the spreadsheet video. Okay, let's go back to the capital asset pricing model. Here's the formula. So R is going to be, we're trying to calculate what the required rate of return is for an asset. So that's going to equal the risk-free rate plus beta times the market return less the risk-free rate. So let's just start inside the parentheses. Why do we subtract the risk-free rate from the market return? We do that because we don't want to amplify the risk-free rate by the beta. We only want to amplify the portion of the market return that's the risk premium outside of the risk-free. So if we subtract the market return from the risk-free rate, we get this risk premium for the market that we can amplify by beta. Then we can add back in the risk-free rate unamplified to get the required rate of return. So the key component here is that for the capital asset pricing model, we are not going to amplify the risk-free rate, just the risk premium of the market by the beta to calculate what the required rate of return is. So this is a great model to use to figure out what your required return is for a stock based on how the beta for the stock, the volatility of the stock or correlation of the stock is compared to the market. Now, risk-free rate, you may ask, well, what is that? Well, we typically consider that the 3-month Treasury bill. So the Treasury bill is considered a risk-free asset or asset without possibility of default, or the asset with the closest to zero in possibility of default, because you can never really say never. Now, if we look at historical risk premiums, if we take, we're going to look at stocks minus the risk-free rate of 3.8, and this is not the current Treasury bill rate, but this is the one we're using for examples. So if we take the stocks minus the risk premium, we find that this is the risk-free rate. The stocks minus the risk-free rate, we get a risk premium of 7.6, and for Treasury bonds, we get a 1.5. So stocks have a much higher risk premium, which is one of the reasons they have a higher return, or also a higher variability of returns. So just some comments in the capital asset pricing model is that to estimate a stock's beta, analysts generally have to use the historical data, and the beta could be anywhere from 3 to 5 years worth of data. Now, beta is based on past data, and past share price specifically. So it's not, we can't say that the past share prices are always going to be a very accurate predictor of future share prices. So, and you'll see this in most any portfolio, it will say that past performance is not a predictor of future performance. So in this case, we only have past stock data to work with for the beta coefficient, and that's one of the drawbacks of the capital asset pricing model because it may not duplicate in the future. So betas are going to be, reflect our feelings of what we think the expectations of the future will be, but it's not a guarantee. So the capital asset pricing model was, of course, developed to help us create what would be the required rate of return. So to explain the behavior of security prices, we use beta within the capital asset pricing model as our formula to show the impact of investing in this asset or portfolio of assets. So there are studies that support the usefulness of the capital asset pricing model to predict that stocks with higher betas will have higher average returns. So companies have adopted the capital asset pricing model to assess their required returns and demand of shareholders. So even though nothing's perfect, the capital asset pricing model isn't perfect, beta isn't perfect, but this is the closest thing we have to an accurate measurement of risks and the required return needed to compensate us for the risk of a particular investment. Okay, so that is the end of chapter 8. I also recommend that if you're following along on the YouTube playlist, the next video after this will be the spreadsheet video where I show you how to calculate a lot of the formulas in this chapter in that spreadsheet. And as always, please read the textbook. The textbook is a great resource to reinforce a lot of the concepts that you may have been hearing for the first time in this presentation. Thank you, and I'll talk to you soon.